Welcome back into Clearpath Retirement Radio. I'm your host, Stuart Smith. I'm here with Mitch Davies, and it is time for Mitch's Market Minute here, and we are going to jump right in. Mitch, take it away, man.
Thank you, Stuart. I'm excited as always. We're talking about a lot of tax and estate and all this stuff, but we're also managing money. And, people are always, what do you guys think of the market? So that's what, take a couple minutes here. Usually we'll stick to the same structure. We'll talk about where the markets are at, what kind of economic stuff we're watching and what we're really focused on, for the rest of the year, this week, all that stuff. So right now, markets are doing well. We had, rough start to the week, but then decent day yesterday. We're about 3% down from all-time highs, but we're still, in a bull market. We're still doing well. We kicked up to all-time highs after the deal was finally signed with the Iran conflict. So that's over, it seems. It's not inked yet, but we've been talking about this thing for months, man, and it's hopefully over. I guess the nuclear agreement was reached and should be good there. We're waiting for the final signature, but the Strait of Hormuz is finally open. There's no tolls. So seems like there's no funny business there left, but the markets are still holding on to a little bit of volatility. I think until the deal is signed and inked and official, that we're going to see some fluctuation. The other big thing going on that everyone's been talking about is rate hikes. So we had the new Fed chair come in last couple weeks ago, Kevin Warsh, and now they're predicting a couple hikes this year. It's actually more probable now that we get 3 hikes than we get 1 cut. So yeah, and that's scaring people because we were counting on, we had 2 cuts last year. We're kind of counting on more cuts coming down the pipeline this year, but we've had high inflation data. A couple weeks ago, we had 4% in the CPI numbers, which were very highest in a couple of years. And when inflation is really high, the Federal Reserve feels like they can't cut the rates. Everyone wants rates to go lower because we want lower mortgages, lower, interest rates, all these things. But when inflation's high, they can't cut it. And they're made that clear. They're not changing their stance on that. So until we can get inflation down to 2%, which who knows if that'll ever happen again, they're not going to start cutting rates for a bit. So we're expecting a couple rate hikes this year, which is unfortunate. So we're going to continue to monitor that. The markets don't like to see that. The reason we talk about that is when rates in the stock market are supposed to trade inverse. When rates are low, you can't earn money in these fixed interest accounts. So people put money in the market and vice versa. When rates are high, people flock to safer accounts to put money in CDs and treasuries and that sort of thing. The other big thing we're watching is all these IPOs, all these new companies coming to the market. We talked about SpaceX last week. We said, hey, be careful. It's going to spike up on the first day and then drop back down, which is exactly what it's done. It's almost back down to where it IPO'd at. And this is, again, we've just been watching these companies come out of the market for 20 years. This is what happens every single time. A lot of these shares are held in a lockup period, which means the people that got in a private, they work for the company, they're private equity, they have a period where they can't sell. So a lot of these shares are locked up right now. So we would say, wait for the lockups, wait for at least 3 to 6 months to buy new companies. And we're going to caution the same with the other new companies that are coming out. This year is the craziest year we've ever had in the stock market. We have 3 of the biggest IPOs ever happening with SpaceX, Anthropic, which is the company that owns Claude, and then OpenAI, which is ChatGPT. All huge companies, all going to change the landscape of the stock market probably forever. There's a new rule that allows companies to now go into the NASDAQ in 15 days. It used to be 6 months. So the stock market landscape is changing. We're watching this closely at the firm because our clients want to know, hey, when are we buying into these companies? Are we investing in these? And we're saying the same thing. In retirement, we can't afford to buy overhyped companies at high valuations. Let's wait for things to come down. Our rule is at least 3 to 6 months on these new companies because historically the same thing happens every time. We're watching that closely. We're watching interest rates. We're watching for this deal to be signed. But right now, markets are still good. Companies are still earning well. And we'll talk next week.
Yeah. So, a couple of things I'm hearing from there is, if you're looking at buying a house, you might want to go ahead and do that pretty quick.
Yeah.
If you are shopping CDs, you might want to hold off and buy them later. And if you are feeling like you have FOMO on all of these new, SpaceX and Anthropic and ChatGPT or OpenAI coming to market, and you're missing out on that. If you're retired, stay away from that
Don't
stuff.
have FOMO.
And don't have FOMO and don't feel bad about it. I mean, SpaceX lost $600 billion the other day, of uh, uh, value in one day. And so, it's these things are volatile and they're just too volatile to be messing with in retirement.
Right.
If you're young and you have a high risk appetite, it's a different world.
Sure.
Right? Different world. So, okay, really good one, Mitch. Thank you for that update.